Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the cash flow memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
Exhibit C first, $62 oil is doing its job. Production is definitely lower in the U.S. and in OPEC and non-OPEC countries. The latest developments in Gaza, where there is a plan which has been signed off by most of the Arab, Saudi Arabia and UAE and most of the Arab countries, is probably going to cause oil pricing to be somewhat weak as compared to the last 2 or 3 weeks. I think that what will continue to happen, though, is the Saudis will continue to increase production. We have them here at 10.5 average for 26, 10.1 for 25. Their overall capacity is 12. So when we go up to the top at this prediction in 26, there's 2.5 million barrels of surplus capacity. 1.5 is theirs. And if you go back to 22, the surplus capacity was 2.4. So if we do get down and the amount of surplus capacity in 26 is only 2.5, we'll be back to a normally supplied market. And you would think that oil would start to trade in the 70s. Now, that doesn't mean to say in the process of getting there, it doesn't trade into the 50s, because that could happen. But I think the impact of low oil prices is working its way through the reduction in supply. Bottom of the Exhibit B page, you can see that oil is flattened out. There's no contango. It should be an increase slope for future prices or backwardation. Gas has not performed too well, but we have a great deal more gas in storage. Everyone says AI, but you can see on the power line, gas production used to make power is flat, 25 versus 24, and that was unanticipated. So I think to the extent that was kind of a one-year phenomenon with the Trump administration encouraging coal plants to keep running, and with solar and wind capacity getting finished, there'll be very little start in solar and wind capacity for the remaining 3 years of the Trump administration. So I think that power line will start to go up, which is important. LNG has gone up in a significant way this year as compared to being flat, 24 versus 23. Would be really terrific for the price of natural gas getting back established in the $4 range to have the power line start to go up. Exhibit A is very much in the news because a cash flow statement for the U.S. government, because we now have a shutdown. They held another vote today, and the Republicans lost one senator, Rand Paul, and picked up 3 Democrat senators, but I think they need 6 more to get to 60 votes, or maybe 7 more. I assume that the Senate Republicans will continue to hold a vote every day, hoping to pick up some Democrat votes to get to 60. I think the argument for doing a continuing resolution until just before Thanksgiving is to allow the Senate to complete work on the 12 expenditure bills. I believe all 12 expenditure bills have been passed through the House. Obviously, to get 60 votes on those expenditure bills in the Senate, you're going to have to make some compromises and then put the bills in conference with the House. But all that is feasible. I think the argument by Schumer and Jeffries that the continuing resolution is unsound and giving the Trump administration too much authority doesn't really hold water. What they should be doing is working on those expenditure bills. Both houses of Congress, I don't think, have passed all 12 bills for quite some time. So we have this system where rather than complete the builds, we have these continuing resolutions. It's not the way the system is supposed to work. And the question always is, who's going to win politically? I think that the Republicans have a better case there, but time will tell. And I think there are plenty of Democrats in the center of the political spectrum who may be motivated to join and get 60 votes to have the continuing resolution. Mike, Jason, anything else to add on macro affairs?
I think you covered it.
Yeah.
We might not get jobs data later this week. And so maybe the question is, does it matter?
Right. Next, we should switch to biotech history. So over to you, Jason.
Yeah, sounds good. Last week we covered Genentech and their path to prove out new biotech business models and create a blockbuster drug in the process. So in the 80s, we really saw a boom in biotech companies successfully bringing more blockbuster treatments to market. So I guess another one of the standout companies I want to highlight is Genzyme for two reasons. And the first is they were founded in Cambridge, Mass. So that was really the forefront of causing Boston to be the second biotech hub outside of San Francisco. And then the other thing was they decided to focus on rare disease. So in their case, it was a condition called Gaucher's disease. And their therapy was an enzyme replacement treatment, which was able to successfully demonstrate a business model can be built around treating rarer diseases. So a couple years prior to that, the FDA was trying to push for this kind of thing to occur with the Orphan Drug Act, and they were actually one of the first companies to take advantage of that. So two big developments for later on as biotech progresses. But that puts us in the 1990s. The success of recombinant DNA technology created an excitement for decoding the human genome. So what was kicked off that year was the Human Genome Project. Eventually it took 13 years and I think $3 billion, which was a massive sum to throw at it at the time. Seems like nothing with the amount we invest in AI today. It was ultimately successful and provided kind of a blueprint for the future for locations for these biotech companies to look for potential therapies as if reading the whole genomic sequence for a human. So it's kind of an exciting thing to be able to. The idea was you could engineer treatments now for the root cause of all diseases, which is the path we're going down now, but maybe is kind of a grand goal at the time. So what last week we touched on the invention of PCR testing as a way to copy DNA fragments. In the 90s, we were beginning to use that technology to test for genetic markers that predispose you to specific diseases. An example of that would be the BRCA gene for breast cancer. But at the time, we were also starting to experiment in methods that we could potentially copy entire sets of DNA. So in 1996, a team of scientists in Scotland developed a nuclear transfer technique where they're able to take the nucleus of a cell and put it into a reproductive egg cell. And they did this with a sheep and ultimately successfully cloned Dolly the sheep, if you guys remember that story. It was big news at the time.
Do you know why they named the sheep Dolly?
I know who it was named after. Yeah.
So the donor cell that they used to create Dolly was taken from the mammary gland of a healthy sheep. And the guy Wilmot, who was head of that research laboratory, said Dolly is derived from the mammary gland cell, and we couldn't think of a more impressive pair of mammary glands than those of Dolly Parton. So kind of a wild story. It's in Wikipedia, so assuming that's true, couldn't say that on TV today, I don't think.
No.
Nice.
But yeah, that
got you off track there.
That experiment, it'll have big implications later on for stem cell therapies. So kind of proving out that we can reprogram cells to act in other ways. In this case, the mammary gland cell becoming an embryo. So now at this point in time, we're in the mid 90s, we're kind of entering an era where genomics is informing drug discovery and also treatment decisions for patients. So if we can look for specific genetic markers, we can identify a particular treatment that the patient should receive. And Genentech, again, was kind of on the forefront of this. They had a streak of hits through this time. And in the mid-90s, I believe 97, 98 timeframe, they had 2 monoclonal antibody treatments, Rituxan and Herceptin. So those were used to treat lymphoma and HER2-positive breast cancer, respectively. So what they were able to do was, again, using recombinant DNA technology, they grew antibodies that would specifically target receptor sites on these tumor cells. By binding to those sites, these antibodies would slow the growth signaling pathway of the tumor cells, and also kind of make them more visible to the body's immune system. So,
a point on monoclonal antibodies. So there's a link back to the companies we talk about in the memo. Everybody remembers Vertex Pharmaceuticals. Their first drug, when they were still a cash-burning, money-losing startup, was a transplant rejection drug, basically to enable the body to accept a donor, liver, kidney, et cetera. That drug never made it to market because the first monoclonal antibody, OKT3, which was approved, I believe, in the mid-'80s, 86, Johnson & Johnson developed it, basically wiped out any need for a second product in that market. So there's a link back to them. And then also Regeneron, which was founded in 1988, also had a big monoclonal antibody program. So you can see, like, different decades, you basically have companies focused on different research areas. And you can kind of see that with Regeneron and Vertex actually have a lot of similarities.
Yeah. Those trends still play out today, but monoclonal antibodies is maybe the most important class of drugs discovered. For today, they're still the highest grossing drugs. So Keytruda is an antibody therapy, and it's the highest grossing drug on the market today. Well, maybe
of all time.
Maybe Ozempic the year past it, but
right. Good. Well, I think we may have completed the history. I have a proposal which I haven't discussed with either of my colleagues here, but it seems to me these history things have been good. And, Gwen, our granddaughter, and her friend Holly did some of this 2 summers ago. I wonder if we shouldn't each week pick something really controversial, and between the 3 of us combine on a history of that particular entity. And before we get to the early pages or talk about healthcare, I think the one, at least conversation between the 3 of us and between the 2 of you, most controversial right now is OpenAI. And I think it would be interesting next week, to the extent we can get ourselves prepped, to spend 7 or 8 minutes on the history of OpenAI from day one. When,
no shortage of controversy in the history of OpenAI.
Yeah.
Yep.
I'm thinking, we do this 52 weeks a year. I think it would be interesting. I'm not saying that we won't at some future time revisit OpenAI, but I think we should try to do at least a dozen controversial companies in descending order before we get back to OpenAI. But next week would be OpenAI, and maybe the week after that, since they're kind of linked at the hip, given the commitment we made, and because Larry Ellison's kind of an interesting person anyway. Maybe the next week we do Oracle from day one. What do you think, Mike and Jason? Is that a kind of a? I think we can do that without pulling time away from other things the 3 of us are doing.
I think it's a great idea. Yeah. Because sometimes we talk about these companies frequently with our collective context that isn't as easily communicated on the podcast. So giving a little background I think will go a long way.
Yeah. The page I updated this weekend was the NVIDIA page, which is page 3. If we're doing a pattern of most controversial to next most controversial, we might go OpenAI, Oracle, NVIDIA. But one interesting thing about NVIDIA, and this is updated for the interim report through June, there's no debt in this company. There's over $50 billion of cash on hand. The company does not have a great deal of capital spending. This is not like the hyperscalers where they're spending half or more of their cash flow. I mean, capital spending was $4 billion. Free cash flow by, on kind of a run rate basis, not a trailing 12 months, but more of a run rate basis based on the June financials was $85 billion on $170 billion of revenue. If you'd come to any of us, I don't know, 4 or 5 years ago and said, would it be possible on a scale like this to have free cash flow equal more than half your revenue? We would have said, no how, no way. That's just not feasible. But that's what NVIDIA's been able to pull off. If you take Advanced Micro by comparison, very successful company, lap Intel, in terms of hardware, but still under $30 billion of revenue, only about $4 billion of free cash flow. Or Intel, which for the longest time, in combination with Microsoft, just had a really strong position with Windows software and Intel chips, $50 billion or so of revenue and negative free cash flow. It's just an extraordinary performance. And of course, Intel's up quite a lot from the 20 range up to 35 based on NVIDIA investing in it and the US government investing in it and rumors that Apple's going to invest in it. It seems to me that normally that you'd expect in something like this, some kind of reversion. Somehow the gap between these three companies would narrow. As I look at NVIDIA and think about what they've been able to achieve and their position, I think it's much less likely that the gap will narrow. I think there's just kind of a permanent gap, and Mike, that's a conclusion I think you subscribe to, probably Jason too. But any commentary on that?
Yes, on a number of fronts. We've talked about this before. NVIDIA's got a huge head start in this market because they opened up their GPUs to be able to be programmed through an API. That system's called CUDA. We've written a few articles about it and why it's important, but it creates essentially a network effect. And ultimately, it reduces the cost of ownership for customers. And the easiest way to rationalize this is that if you were to offer somebody free AMD GPUs versus NVIDIA's solution, they will always choose NVIDIA's because it will cost them more on a total cost of ownership perspective to try to make AMD's system work for their stuff. Now, there's a scale to that. At some point, the scale of adopting either an ASIC or a third-party GPU to work for a very stable workload will make sense. And that's probably the question we have to ask about the long run is there going to be so many stable workloads that it'll make sense to optimize the hardware and the software on a one-off basis? Or do we think that the workloads are going to continue to vary and maybe even vary more than they do today, which what we've seen so far seems to make the most sense. So that's one factor where they've developed a very strong moat. The other piece of their moat that I think is hard for anybody to compete with is their cadence, their what we like to refer to as process power. And what that is they're releasing a new line of GPUs every year. And it is very difficult to do that. They're doing it with $15 billion in R&D spending, which actually, at the end of the day, isn't that much. They claim to be using AI directly with their software and chip engineers in order to improve their output. But you look at the return on R&D that NVIDIA is getting for $15 billion a year versus AMD or even Intel, which is spending almost as much, 14. And look at the productivity gap. I mean, it is very difficult to select a company based on R&D productivity. But when you look at it from a process performance perspective, in other words, how fast are they releasing newer and better products? It's hard to argue that NVIDIA is not far, far ahead of everybody else. So those are the two big things that we like about NVIDIA.
Yeah.
Okay, let's take a quick break for a message from Oak Cliff Sailing.
Hey everyone, it's Allie and I'm on board of Oak Cliff Far 40 Blue, which will be getting a massive refit showcase at the Annapolis Boat Show. We have our team of Aaron, our 540 Blue boat captain, Siri, and Luke getting the boat prepared. If we look behind us, we are taking off our old winches and replacing them with new Harken winches. And right behind that is our cockpit, which we will be hosting a lounge event. If anyone is at the Annapolis Boat Show between the hours of 4 to 5 every day, we will have food and snacks, and please make sure to come by and you can get a little glimpse of what it's like to be on board of 540 Blue in preparation for Bermuda, which is next year, and we have our Acorn program spots coming up shortly. If you haven't bought your tickets yet for the Annapolis Boat Show, please make sure to do so using the website racingcalendar.org, where you'll get a link to buy tickets using the code OAKLIFT2025, and a portion of the proceeds will go to a donation for Oak Cliff Sailing. We have the whole team excited for our delivery this Saturday, so please make sure to stay in tune with our Facebook, Instagram, and YouTube for updates along the ride. And while we're at the event, we'll have live videos. So if you're at home and want a little glimpse of what it's like for Oak Cliff to be at the Annapolis Boat Show, please make sure to tune into our lives. Thank you so much.
And now back to the show.
Jason, we have to switch in healthcare, but anything more on Mike's points?
In the past, maybe a year ago or so, we used to talk about, was AMD going to catch up and take market share from NVIDIA? No one talks about that anymore. One thing Mike said is when you get to a certain scale, the choice becomes, do you shift to AMD chips or ASICs? And everyone has chose to go to ASICs. So they'll design their own chips, such as Google's TPU. They'll build their own versus buying AMD's. So AMD has really become an afterthought at this point. And then to the point of, are there going to be enough stable AI workloads? I think so. But at the same time, researchers at the cutting edge of AI have been saying that language models are not the end state for these AI algorithms. They're working on other methods to create better reasoning, better decision making, better AI. Essentially, it's not going to be a language model based system as we know today. So if those are successful in producing better results, or it's a way where there's a path towards generalized AI, we may see a shift. But language models today are certainly extremely useful.
Right. To switch to healthcare, we all know that Jason really doesn't like one of the principal sources of profit in United Healthcare, and must be rooting every time he sees an announcement, latest by Pfizer, to sell directly to consumers at lower prices. This won't work for every pharmaceutical, but United Healthcare has been one of the best performers in healthcare. But I mean, without the profitability of being the middleman between the companies making the drugs and healthcare plans, whether it be Medicare or Medicaid or private plans, I just can't imagine that United Health Group will be able to perform as it's performed in the past. I have to be much more familiar with the company to be able to estimate what part of the $30 billion of free cash flow comes from their acting as the middle of all these transactions in pharmaceutical. But Jason, wouldn't you think it'd have to be 30 or 40% of that 30 billion of free cash flows?
Yeah, I think it's a big chunk. Yeah, so the big announcement is Trump RX. It is a direct-to-consumer platform for recipients of Medicare. Pfizer's the first partner. What they've announced is it's in theory, as it matures, I think it'll become an aggregator of filling prescriptions for Medicare recipients through an online platform. And I think the market might drive that for private insurers as well. But we're starting here. Essentially, the government's removing PBMs from that process. So first, for the consumer, there could be a marginal benefit where their Medicare Part D plan, they won't have to worry about if something's in the formulary there or not. But really the big impacts are for the pharma companies. After the announcement, the pharma companies are all trading up today. one thing they're going to get is stable pricing. So they won't have to negotiate every year or so with the PBM and fight for their share of the drug revenue for their products. So they're going to get some clarity there. The thing they negotiate for is something called a gross to net ratio. That is to say the net sales that Pfizer receives from the gross proceeds of selling their drug. The industry kind of settles around right around 50%. So the PBMs are doubling the cost of the drug before it gets sold. Not all of that is passed on. Some of that's rebates into the Part D sponsors, so your plan administrator. The funny thing is United Health Group owns that Part D plan. They also own the PBM. So they're paying themselves two different ways. The gross to net ratio I looked up on the top drugs that Part D spends money on. This is $30 to $40 billion a year. The top 5 drugs all have a gross to net ratio in the 30s. So the top one is a blood thinner. It has a gross to net ratio of 39. That means the manufacturer of that drug sees 39 cents to the dollar of the sales of that drug. The other two are, the PBMs taking their rake and the plan sponsors receiving their rebates. So if you look at all of the drug spending by Part D on branded drugs, so not the generics, they spend about $230 billion a year on branded drugs. It's easy to assume we could see a 50% savings, since Medicare and the government are the payer in this situation, and they're going to remove the PBM. So by selling direct, it's not out of the question that we see $100 billion savings annually from Medicare spending.
Bigger picture, the healthcare system does not work as an efficient market. So one way you could go in and try to fix a market that has monopolists, which is basically what this is, you can go through the judiciary. This approach is potentially a new way of dealing with competition, where you just introduce competition that upends that market. And we think broadly that this will pave a path for the private insurers to avoid PBMs as well.
You'd have to think there's going to be an aggregator of sales. And e-commerce is a great platform, great example. There's going to be an aggregator of pharmaceutical sales. It's easy to think it could be an Amazon or a Walmart.
Yeah. Or both.
We promised last week to cover your investor day with Harrow. Any highlights on Harrow?
They fully acquired the rest of Moat, which is a spin out. We love their capital allocation strategy. They spun out a new drug, let other parties kind of fund the riskiest parts of that. Now that they've had successful phase 3 data, they've repurchased the other half of the business that they didn't own.
And what's important to understand is that Harrow was a much smaller, much less financially stable company when they spun that out. Today, they're a financially stable company. They're running cash flow positive. They're in a much healthier position to be able to afford this.
Yeah. I still think it's a great strategy to spin these out.
Yes, 100%.
And so the Moat's drug is an anesthetic. It has great use for ophthalmology, but much broader use potentially.
And they acquired the rest of the rights for $8 million. Is that right?
$8 million upfront.
Yeah. And there'll be obviously some royalty payments associated with it, but now they have full control. It's exciting because the market opportunity in ophthalmology is great, but there's other markets like dentistry and others that it'll be good.
Absolutely.
Right. In the meantime, we're over. Everyone be well and stay healthy, and we'll be here exactly 7 days from now. Take care, everyone. Thanks for listening. Bye-bye.
The views expressed on this podcast are the hosts alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.